Hey guys, I'm John Fryer. Welcome to Fryer Funds. Welcome to my kitchen. Today I want to talk about 3 questions that a lot of new investors like to ask, especially right now with the markets in turmoil. So the first question is, how much do I need to invest? Now this depends on the person and your goals. So if you're really young, you're looking to retire when you're 60, you don't have to invest that much right now. If you're in your 50s, looking to retire in your 60s, then you've got to make up for a lot of time and you need to invest more. So how much to actually invest comes down to you and your situation. I would say at minimum, to learn the basic ropes, about $10 a month if you're looking at investing a little bit every month. Realistically, if you want this money to actually grow and turn into something, you're going to look at about $100 a month if you're younger. And if you're older, it could be as much as, say, $5,000 a month. Of course, this comes down to the person that you are, what kind of investments you're making, and what your goals are. So if you want to get started with investing, just to learn the ropes, $10 a month, count it as a subscription basically. You're buying something for $10 a month, and what you're buying is a return on your money down the road. The next question I want to talk about here is what do I invest in? Now, individual stocks is a whole category of its own, and that changes fairly consistently. So I don't want to talk about individual stocks. If you want to look at buying individual stocks, then that's fine. You can do your homework there, and we'll do that a bit here. But for this purpose, I want to talk about 3 portfolios and their situation, or their purpose rather. So the all-weather portfolio, a very popular portfolio built by a guy named Ray Dalio. He has a huge hedge fund. He's one of the largest, if not the largest, hedge fund out there. He came up with this portfolio a while back, and it was popularized by the book called Money, Master the Game by Tony Robbins. Tony Robbins, if you haven't heard of him, great author, motivational speaker, that kind of a guy. So I'll leave the link to the book down in the description if you want to read it. But basically it comes down to a little bit in the total stock market, a lot in long-term bonds, a decent amount in intermediate bonds, and then some in gold and some in commodities. And I'll show you here in a little bit what those breakdowns actually look like, and you can break it out yourself. The second portfolio is the Golden Butterfly. This was built about 2015-2016 by a guy who built a website called Portfolio Charts, and I'll leave a link to this in the description, that broke down a lot of the portfolios, a lot of their performances over the past, and came up with the Golden Butterfly portfolio, which is a little bit simpler than the others in that it's exactly 20% in each of 5 categories. The total stock market, gold, long-term bonds, short-term bonds, and small cap value companies, or the index of them. So we're going to go and look at this here in a little while, and its returns as well. And then finally, the final portfolio I want to present to you is one that I've recently come up with, looking at those 2, a few others, back testing it and seeing how it performed, because personally I don't like a lot of risk for the capital that I'm concerned about, but I still want more growth than the other 2 were providing. So I built what I'm currently calling a fryer pie, but I need a better name, so feel free to leave a comment down below on a better name for this, and I'll show it to you here in a little while. But it's the S&P 500 long-term bonds, a more intermediate long-term bond, and then gold. And I'll show it to you here in a little while with an experiment we're going to run. Now, the final question, when to invest. This does matter to an extent depending on your goals. Now, if you invest at the exact wrong time, it could really kill your portfolio. If you invest in the exact right time, you'll be rich really quickly. So trying to time it, however, is virtually impossible, and timing the market does not beat time in the market. At least that's how the saying goes. So we're going to look at this, but if you invest a large lump sum up front and you happen to get the wrong amount or the wrong timing, then yes, you could have issues. Portfolios like I've talked about with the all-weather, the Golden Butterfly, and my portfolio that I recently built, that has less of a drawback, but doesn't have the same amount of gains. And we'll take a look at that. So I want to run an experiment with you guys. Most of you get paid, I assume, bi-weekly. I'm going to run this every weekend, so that you guys can follow along no matter which Friday you get paid. So over the weekend, you're going to take whatever amount you're going to do. I'm going to do $100 a weekend, and you're going to invest it in whichever portfolio you want to. I'm going to do all four. I'm going to do my Friar Pie. I'm going to do the all-weather portfolio. I'm going to do the Golden Butterfly, and I'm going to do just the S&P 500, and you'll see why. So $25 into each one each week, $50 every other week. So if your paycheck is every other week, you want to do $50 a paycheck, you can. It's $100 a month. And we'll break this down here in a little bit. To do this, we're going to run a program or use a brokerage called M1 Fiance because it makes it very easy to build these portfolios and have it automatically distribute across the board. If you're using Robinhood or Webull or Fidelity or any other brokerage, you can still do this. We're using common tickers. I'm just building it in M1 Fiance. If you don't have M1 Fiance and you want to follow along, use the link below, sign up, you'll get your first $10 for free. And they'll give it to you once you deposit $100. So if you start with $100, they'll give you $10 more just to start. That's a 10% instant return for you. So check out the link below. I'll also leave links to Robinhood, Webull, and possibly a few others. You can try those and get your free stocks and free money there. So let's jump in, and take a look at what your returns will be and what we can kind of expect and how M1 kind of works. So let's jump in. Here we are on Portfolio Visualizer, a free website that lets you backtest different stock tickers. Now, legal disclaimer, of course, previous performance does not guarantee future performance. This is not financial or legal advice. Consult your own advisors and make your own decisions. Okay, so let's get into this. Everyone is worried about investing at the wrong time. So I set this up for November 2007, the worst time to start investing at the stock market. Initial investment amount of $10,000. I've set up the 3 portfolios, with portfolio number 1 being mine, portfolio number 2 being the all-weather portfolio, and portfolio 3 being the Golden Butterfly. I do want to point out that going forward, I won't be using the Spider S&P 500 ETF. I'll be using the Vanguard S&P 500, ticker VOO, because it has less fees, thus ultimately will have a little bit better return. So let's go down to the graph, and right here at the bottom, the S&P 500 lost 51%. So your initial $10,000 investment was worth only $4,900. Meanwhile, my portfolio and the all-weather portfolio were both down about 8%, and the Golden Butterfly was down about 14%. Go forward to 2012, August, if I can find it here, you finally have your $10,000 back in the S&P 500. Meanwhile, all 3 portfolios are up about 50%. Okay, so finally the S&P 500 caught up to the all-weather and the Golden Butterfly in 2017. And then finally with mine in 2018. And since then, there's been a lot of volatility, and we've been going back and forth. Currently, I'm in the lead because of the recent pullback. Meanwhile, the other 2 are a little further behind. So your initial $10,000 investment would be worth $27,000 today. In the S&P 500, it would be $24,000, and then $22,000 and $24,000, give or take, for the other portfolios. So let's change this up, though, and say you invested at the correct time, the best time, March 2009. Now, the S&P 500 completely blows these other portfolios out of the water. Even with the recent pullback, it's nothing compared to the returns you've had. Your initial $10,000 investment is now worth $50,000. It was actually almost $55,000 just a month before. So these portfolios are great at capital preservation and slower but decent growth. However, they're not great at accelerated quick growth, depending on your time frame, of course. So invest money that you're okay with pullbacks in the S&P 500, but for capital you need preservation for, such as retirements, a portfolio like one of these 3 works out really well. I also want to take a look here, which breaks down each year and its returns. You'll notice 2015, all three portfolios were down. Meanwhile, the S&P 500 was up, but only just a little bit. 2018, everything was down. It was actually a worse year for these three than 2008. So let's get into M1 Finance. When you first log in, this is what you'll see. I've already set up the all-weather, the golden butterfly, and the S&P 500. But I want to show you how to create a pie and then add it to your portfolio. And you can split it up like this. However, this is more for educational and testing purposes. I don't know if I necessarily personally, with my big investments, go with splitting it up between these portfolios, but you can do as you need. So let's go to the research tab. On mobile, that's going to be down at the bottom. You're going to go to research and then go to my pies. And you can see I've already got these set up. My account, yours might be called my portfolio or M1 portfolio, whatever the default is. I forgot what it was. I've already changed it to just say my account. This is where you're going to end up investing with all your pies. And what you could do is change your pies out depending on what's going on with the market. So if you want to invest in a portfolio like this, at turmoil times like right now, you can. And then when you're ready, you want to save that portfolio, you mark it so you're not using it, and you use the S&P 500. I, of course, will be using all just at the same time. So I'm going to create my portfolio by creating a new pie. And you'll see different stock tickers for different companies here. If you go to funds, that's where the ETFs are. So I want to search. I want the Vanguard S&P 500, which is ticker VOO. Add that to basket. I want long-term bonds, TLT. Add that. Medium-term bonds, TLH. And finally, gold with IAU. Okay, add all that. And it'll default to 25% in each one. So I'm going to edit. Change TLH, which is the medium, to 10%, if it'll let me. 10%. TLT to 40. Gold to 15. And finally, the S&P 500 to 35%. Now, I'm going to call this Friar Pie for now. However, I'd like to come up with a much better name. Friar Funds doesn't work because that's going to be individual companies to invest in. So let me know what your thoughts on a good name for this portfolio would be. Leave it down in the comments. Okay, so save that. And there we go. So 5 years, 37% return. Over 1 month, 4.5%. Over a week, 3.4% return. That's not too bad. So we can go back to my pies. Here it is unused. I want to add it to my portfolio, which is what I'm investing in overall. And we're going to do 25% on each one. There we go. And save. All right, cool. Maybe. That took a wide load. All right, so M1 Finance, by default, of course, I had nothing invested. They're all set up for 25%. I have $100 in cash. Now I'm going to invest $100 a week going forward to invest in these. And I'm going to turn auto investing on personally. So save that. So tomorrow at 8 a.m., it will invest $100 into these three portfolios, these four distributions, the last one being the S&P 500. And then next week, we'll deposit another $100 and let it distribute them automatically and check how we're doing. Okay, so as you can see, timing the market can make a difference. Time in the market will make up for it. If you have a large capital and you want to preserve it, such as if you're retired or coming close, a good portfolio like one of these three is very critical. If you don't have a large capital and you just want to invest over time like we're going to do, it can make a difference, but less of a difference. And I want to show that to you and take a look at what would have happened if you did $100 a month for the last 10 years and what that looks like between these. So let's dive into that. Back here on Portfolio Visualizer, I want to set this up a little differently now. So instead of a $10,000 initial investment, we're going to do $100. We're going to contribute a fixed amount, $100, not adjust for inflation, and do it monthly. All right, so let's analyze here and take a look. Now, the graph here is a little harder to read. There's a little bit of a pullback back then for the S&P 500, but if we turn off logarithmic scale, here you can see the S&P 500 did start to take separation in 2013 and really grew a lot more than these three portfolios. And you can see the final balances here. Now, these are a little misleading in that it didn't turn $100 into this because you're adding $100 a month over time. So I'm going to make that math a little easier, and we're going to just jump back 10 years. So 2010, March. Now, the scale looks more like this. So the S&P 500 is still way ahead of the others. But for easy math purposes, 10 years, $1,200 a year, that's $12,000. Your $12,000 that you've invested over the last 10 years would have turned into $22,000 with the S&P 500, about $19,000 under my portfolio, and then $17,000 with the other two. All right, guys, I have to insert a new clip here. Everything else was recorded over the weekend, and I meant to get that video up to you on Sunday. However, I ran into issues, so I turned off auto invest in M1 Finance, and now that I'm fixing those issues, we've had the crude oil sell-off causing the stock market to crash. So it kind of worked out in my favor in that case because I did miss that particular pullback. So this gives you a few extra days. This weekend, March 14th or 15th, I'll turn on auto invest, so we'll automatically invest next Monday and then go from there. I also want to point out that this portfolio visualizer website does not do it by day or by week, but it does it by month, so it only has up through February's data. It doesn't have these recent sell-offs to see how they performed. Of course, there are other tools that will if you want to go look for them, but I'm not too worried about it. And then the all-weather portfolio in M1 Finance does not allow for fractional shares. So I did 8% in gold and 7% commodities for now. I might swap that up if I feel like oil's hit a rock bottom, and it'll probably go up. But for now, that's how I'm distributing that fractional percentage. All right, let's continue. Okay, so as you can see, investing a little bit every month over time makes up for trying to have a lump sum all at once and investing it at once. Of course, you put in $12,000, you didn't have the same amount as if you had put in $10,000 up front. And that shows you that timing the market is not as good as time in the market. But you can still invest in increments like that, and that's what we'll be doing with M1 going forward. So next weekend, put in another $100, let it distribute, see where we're at, and we'll go from there. So if you'd like to play around with that tool, I'll leave a link in the description. You can backtest things yourself, try to find a portfolio for your needs, and focus on a portfolio that you're okay with its risks and its previous returns and looking forward into the future. For example, the all-weather portfolio, my personal problem with it is it includes commodities, and commodities includes oil. We're not going to stop using oil, but I don't see oil as the right investment going forward into the futures. When commodity becomes energy from other sources, then adding commodities back into a good portfolio makes sense because commodities are still a good investment, just not the current commodities as we're in this transition phase between oil and more clean energy, and as more and more younger investors in particularly like the clean energy. So that's all I've got for you today. Any questions, leave down in the comments, hit like, hit subscribe, and we'll see you next time.